Mm-hmm.
Okay. Now, interpretation of FS. See, when we prepare FS, when we analyze FS, okay, the next thing that we do is we're going to prepare a comparison of all the elements present in the FS. Understood?
Mm-hmm.
Okay. And this comparison is called as analysis or interpretation. Understood?
Mm-hmm.
Okay. So there is review of raw data, that is review of just the bland that is available, that is the SOPL and the SOFP that we look into, right? Okay.
Mm-hmm.
So when we look into SOPL and SOFP, what do we see? We see that the company has made this much profit in this year, right? And we
Mm-hmm.
see the SOFP and decide that the company has this much assets, this much liabilities, right?
Mm-hmm.
But it lacks a comparison between different elements in the FS. All right. Okay.
Mm-hmm.
So for that purpose, we have ratio analysis. Understood? No?
Mm-hmm.
Okay. So the first ratio analysis, you have four ratio analysis mainly. And the first one is profitability. Second one is liquidity. Third one is efficiency. Fourth one is position. Understood?
Mm-hmm.
Okay. And we're going to directly jump towards the profitability ratios. So profitability ratio simply means that Elvira, keep your notes in handy as and when I take the ratios, just not note those down. All right. So
Yeah.
first, write the site heading as profitability ratios and listen to the lecture. All right. When I say write the ratio, then copy it right away. All right.
Mm-hmm.
Okay. So profitability ratios are those ratios which the companies analyze in order to determine the profitability or profit making capacity of the business. Understood?
Mm-hmm.
Okay. So profitability ratios tells you how much or how capable the business is in generating profits. Understood?
Mm-hmm.
Now, under that, first ratio is gross profit margin. So, gross profit margin actually looks towards how much profit the company has earned in terms of its sales. Understood?
Mm-hmm.
Okay, no? Now, when we say
Mm-hmm.
gross profit margin, what does the gross profit margin include? How do we get the gross profit margin actually? We take the sales, right? We
Mm-hmm.
deduct the COS, right? And then
Mm-hmm.
we reach the gross profit, right? So gross
Mm-hmm.
profit is basically measuring how much profit is left after all the material and direct cost. Understood?
Mm-hmm.
Okay. So the gross profit ratio equation is GP divided by sales into 100. Copy it down. GP divided by revenue or sales into 100. Copied?
Mm-hmm.
Okay. Now, so in your in your exam, you are likely to be tested on just the phrase how if the gross profit is changing, is it because the selling price increased? Is it because the direct cost increased? Understood?
Mm-hmm.
So it is likely that you're going to be tested in an MCQ question, okay? Or
Mm-hmm.
you could get this as an essay question in the section B part, okay? Where you have to calculate the ratios and fill it in the box that is given. Understood?
Mm-hmm.
You know, so changes in so when there is a change in profit, gross profit ratio from the previous year, then it means something. Clear? So it
Mm-hmm.
means that maybe the selling price of the goods changed, right?
Mm-hmm.
We are a business of multiple products, okay, and some product mix has been had a recent change. Then the gross profit margin would also change because the related materials would also change, right?
Mm-hmm.
Now, it may be that the purchase cost, the supplier has increased or decreased the price, right? It also is that the production cost that we take in order to manufacture that item might have changed. Okay. It could also be that the inventory valuations have gone up or low. Clear?
Mm-hmm.
Understood? No?
Yeah.
So, gross profit margin is a very good method in order to compare how the business is doing over time. Okay, it tells us how much of the sales is there, how much of the costs are involved in those sales, what is the trend of the change. Clear? So it gives us
Mm-hmm.
a trend, an overall trend of how the profits have been changing throughout the years. Understood?
Mm-hmm.
Okay, we can analyze trend using that. Okay. Next type of ratio is operating profit margin or net profit ratio, NPR. Clear? So the equation is PBIT, that is profit before interest and tax. So just before interest and tax, whatever is the profit, you're going to take that divided by revenue into 100. Clear? Copy it down. Okay, so profit before interest and tax. So in the question, it might be that you have to add back tax and interest to the net profit that is given to you. Understood?
Mm-hmm.
Okay. Now, the difference between an operating profit margin and a gross profit margin is in its expenses. Okay. So, in gross profit margin, you are only taking the direct expenses, right? So, everything related with the product is taken, nothing else is mattered, right?
Mm-hmm.
Whereas in the operating profit margin, you're going to take everything together. That means all the expenses that you incur in order to, sustain that business, you're going to take that and find operating profit margin. Clear? Okay. So when there is a change in operating profit margin ratio, you can understand that maybe the employment pattern has changed. There has been additional recruitment, or there has been people who are going away from the company. There is a staff turnover. Understood?
Mm-hmm.
Okay. Or it could be due to the depreciation changes. It could be due to the additional acquisitions or disposals that you have made for the asset. Understood? Or it
Mm-hmm.
could be due to the writing off of any irrecoverable debt that has arisen. Clear? It could be due
Mm-hmm.
to any rental agreements that you have done or you have entered into additionally. Clear? It could be due to any expenditure that you have spent on the advertisement. It could be due to any fuel related prices. Understood? So all
Mm-hmm.
this contribute to operating profit margin change. Understood, no?
Mm-hmm.
Next type of ratio is ROCE, okay? Return on capital employed, okay? So the equation is PBIT, that is the operating profit, divided by capital employed into 100. Into 100, not 100 percentage, all right? Into 100. Just cut this percentage. Wrote it down, Elvira?
Yeah, writing.
Okay. Tell me done as soon as you're done. Done?
Mm-hmm.
Okay. So what is ROCE? Tell me what is capital of a business? How does a business get its funds from? The business has two sources, right? One is equity and the other is debt. Clear? Okay. So capital employed is basically equity plus debt. Understood?
Mm-hmm.
Clear, no?
Yeah.
Okay. And operating profit is operating. Just a moment. Operating profit simply is PBIT. Clear, no?
Mm-hmm.
Okay. So if you take the equation directly, you get the ROCE. Understood? So ROCE basically takes into account how much the shareholder gets for all the funds invested in the company. Understood? Okay. How much the shareholder gets for all the funds that is being invested in the company. So ROCE is more the better. Understood? For shareholder.
Capi-
For shareholder.
Capital employed, what will be included? Like, for
Debt and
example,
equity. We have two sources of funds in the business, that is debt and equity. So capital employed is equal to debt plus equity. Clear? You can write it down. CE is equal to, sorry, debt plus equity. Clear? Understood, no?
mm-hmm.
Okay. So we're moving on. Net asset turnover ratio. Next type of ratio was net asset turnover ratio. So net asset turnover basically means revenue divided by capital employed or net assets. No 100, okay. In this, no 100. Revenue divided by CE, okay, or net assets. Clear? So when you do this, what you get is a number. That number should be written as in times. Clear? So if 4 is your answer, you're going to write it as 4 times. Understood? It's a measure. Okay. All of these are not needed. Next one, relationship between the two ratios, that is ROS and the net asset turnover ratio. Okay. So we know that ROCE is equal to ROS and operating profit margin ratio, the relationship. Okay. And also the asset turnover ratio. We are going to look into what does this depict. Okay. So ROCE can be divided into, or ROCE can be measured in terms of operating profit margin of the company as well as the asset turnover ratio of the company. Clear? So you know operating profit margin is equal to what? PBIT divided by revenue, right? Same way, asset turnover ratio is what? Revenue divided by CE, right? So if you just cut revenue off from both the sides, what do you get? Operating profit divided by capital employed. Understood? So this is basically ROCE, right? That is PBIT by CE. Clear? So in a way, we can say that operating profit margin into asset turnover is equal to ROCE. Understood? Okay, no? It's a derivation. Okay? Now, liquidity and efficiency ratios. So next ratio is liquidity and efficiency ratio. So tell me, in a business, what is liquidity? What is liquidity? The use of cash, right? The ability of the business to be able to manage its payables and receivables. Okay. So that is liquidity of the company. There should be a cash balance constantly available in order to run the business, right? So that is called liquidity or efficiency of the business. Clear? Okay. So we need sufficient capital so as to run the business, and that is called as a working capital. That is all the current assets should be enough to pay off the current liability. Understood? Understood, no? So working capital equation is equal to current asset minus current liability. So if this is a negative figure, then the business is in going concern issue. Understood? Working capital should never be negative. Understood, no? So under that, current ratio. So current ratio is simple, CA by CL. Understood? Okay. And CA is current asset, CL is current liability. And whatever you get, if it is 0.5, it is 1.5, whatever the answer is, you have to write it as 1.5 is to 1. Understood? Is to 1. Clear, no? Okay. Now, CA ratio, that is, current ratio shouldn't be too high. It shouldn't be too low. Understood? So high level of current assets, current ratio means there is too much current assets within the company. There is too much inventory, right? There is too much cash. It is bad. Clear? Very low means the company does not have sufficient balance in order to pay off the current liability. So it is also bad. Okay. So current ratio should be kept in an ideal position. Understood, no? Okay. And usually and traditionally, earlier, we used to teach the students that the current ratio is 2 is to 1. Clear? But now, upon the market research, the figure is now updated. It is now 1.5 is to 1. Understood? You know, at least it should be there like that. Okay. These are the ratios that you use in your business, right? Use in your company. Understood? Okay. That second type of liquidity ratio is called as a quick ratio. Okay. It is quick ratio. Otherwise, it is also known as acid test ratio. Understood? Okay. Now listen to me carefully. You have current assets, right? So out of that, there is one thing which is not in a liquid cash, and that is inventory. Clear? So
Mm-hmm.
inventory could only be cash if there is sales, right?
Mm-hmm.
So from the current asset, if you take away inventory as well as prepaid expenses, because prepaid expenses, even though it is a current asset, it doesn't necessarily create a liquid asset, right?
Mm-hmm.
Understood? Because it
Mm-hmm.
necessarily won't make you have a cash in your hand. So prepaid expenses. So from the current asset, if you're going to take off inventory and prepaid expenses, you get quick assets. Understood? So this is quick
Mm-hmm.
assets. Quick asset is current asset minus, write it down, okay? Current assets minus inventory minus prepaid expenses. So if you do that, you get quick assets, and then you are going to divide quick assets by current liability in order to reach quick ratio. Understood?
Mm-hmm.
So it tells us how much of ready cash is available from in the business. Okay. And depending upon the type of business, the ideal ratio could be 1:1 or 0.7:1. Understood?
Mm-hmm.
Okay. So depending upon your business, it changes. If you are a supermarket, your quick ratio should be very high so that you can pay off the customers, right? Pay the balance to customers. You can pay the balance to the suppliers in cash, right? So
Mm-hmm.
depending upon the business, the equation, the normal or ideal range would change. Clear, no?
Mm-hmm.
Understood?
Mm-hmm.
Okay. Now, there is something called inventory turnover ratio. So, inventory turnover ratio is called as cost of sales divided by inventory. Understood? So, that is inventory turnover. And inventory turnover, we are going to calculate that in order to understand how much time does an inventory gets converted into sales. Understood?
Mm-hmm.
Clear, no? So the equation is inventory turnover ratio is equal to COS divided by inventory. Understood? So whatever amount that you get, you're going to represent it in terms of times. Okay?
Mm-hmm.
Next one, inventory days. Inventory days. Next one, all right? Sorry, inventory turnover period. Okay, listen to me carefully. So inventory doesn't convert it easily, right?
Mm-hmm.
And on an average year, you have to find out how much days does it take for the inventory to be converted into sales. Okay. So in order to do that, we have an equation under inventory turnover period, which basically means the days, the number of days it takes to convert the inventory into sales. Understood?
Mm-hmm.
So the equation is inventory divided by COS into 365. So whatever amount that you get would be represented in terms of days. Understood? If it is 70, you're going to write it as 70 days. Understood?
Mm-hmm.
Okay. So inventory holding period, when it increases, it is not so good for the company. Okay. But depending upon which industry your company is, it might be favorable because you can stock many goods at a lower price. That is bulk discount that you get from the manufacturers. Understood?
Mm-hmm.
Okay. And keeping a high inventory level days would also mean that you don't have a risk of restocking items when it gets sold out. Understood?
Mm-hmm.
Okay. And also, if there is too much order, unexpected order in the future, you could still fulfill the order because you have more than inventory left, more than enough inventory left in the warehouse. Understood, no?
Mm-hmm.
So, inventory turnover period could also be expressed in times, and that is COS divided by inventory. Understood?
Mm-hmm.
Okay. Now, inventory turnover days, though, if it is very high, it is considered very bad. Okay. There are businesses which might take years and years to sell off their inventory, right? For example, petroleum, an example. The inventory days are relatively very high for petroleum, right?
Mm-hmm.
But whereas in terms of fishes, in terms of all the perishable items, the inventory turnover is just 1 to 2 days, because after that the inventory gets depleted or it gets bad, right? It gets rotten, it gets perishable. Understood? So depending
Mm-hmm.
on the industry, the inventory holding period would change. Okay, no?
Mm-hmm.
Next equation, receivables collection period. Okay, so receivable collections period measures how many days does it take for you to convert your receivables into cash. Understood?
Uh-huh.
Elvira, don't speak. Understood?
Yeah.
So the trade receivable days collection receivable collection period or trade receivable days actually calculates how much days or how many days it takes in order to convert your trade receivables into cash. Understood?
Mm-hmm.
So this whole thing works upon the depends upon the credit controller. In your company, you may have a credit controller, right?
Mm-hmm.
So that guy is responsible for fixing receivable days. He is responsible for fixing it high, fixing it low. So whatever he deems perfect, he would do that. Understood?
Mm-hmm.
So if it is set too high, it is very bad for the company. That means there is a chance of irrecoverable debt that would arise. Understood?
Mm-hmm.
If it is set too low, means you would have low sales because customers won't get attracted to your company. Understood?
Mm-hmm.
So it should be made in a way that it doesn't make you lose customers. Also, it doesn't lead to irrecoverable debt. Okay, so it is completely upon the credit controller to decide what he has to keep. Understood? No?
Mm-hmm.
Next one, payables payment period. So payables payment period is a ratio which tells us how many days we take in order to pay our suppliers. Understood?
Mm-hmm.
So this is trade payables divided by credit purchases. You should remember always receivable is connected with credit sales as well as payables is connected with credit purchase. Understood?
Mm-hmm.
So trade payables divided by credit purchase into 365 would give you how many days you take in order to pay your current liabilities. Okay. So very long credit payable days is very bad. Understood? Credit period, it is also known as a credit period. And this credit period, if it is very high, it is bad. That means you are basically going to be in trouble with the suppliers. Understood?
Mm-hmm.
Okay. Now, the credit period is also a good thing for the company. Why is that? You can actually use that money in order to not pay the suppliers in something else in the business, right? So it is a free of cost finance. Understood?
Mm-hmm.
Okay. Now, if you keep the credit period for so long, what would happen is your reputation in the face of your suppliers would lose. The suppliers won't give you a trade discount. So many things can happen. Understood?
Mm-hmm.
Now, next one, cash cycle. Next one is cash cycle. So, cash cycle basically represents how many days your business has cash left in it, right?
Mm-hmm.
So, triple C could be found in an equation as inventory holding period plus receivables collection period minus credit payment period. That means up until this time, you have cash within you. So when you pay, the cash is gone, right? So
Mm-hmm.
this is the cash holding period. Okay, understood?
Mm-hmm.
Okay, and it depends upon the business whether or not to set it too high, set it too low, right? So
Mm-hmm.
if you are a supermarket, you have to set it very high because you have cash transactions on a day-to-day basis, right? If your business does not deal with too many inflows and outflows, then you can set it too low. Understood?
Mm-hmm.
Okay. Next is financial position. So financial position basically revolves around how your equity and debt plays a role in your business. Understood? So under
Mm-hmm.
that, first one is gearing ratio. Okay, measuring gearing. Gearing simply means your debt capacity of the business. Understood?
Mm-hmm.
So under that, we have our first ratio, debt bar equity ratio. Clear now?
Mm-hmm.
Okay. And for you, there are two types of equations in it. And the most commonly used equation is this one. Understood? Either you can study it as long-term debt by equity, but the chances are when this question comes in your exam, there won't be an option that you can select which would be equal to this equation. Understood? There would always be answers which relates to this equation. Understood?
Mm-hmm.
So the first equation is debt by equity. Second equation is debt by equity plus long debt. Understood? Okay. First is
Mm-hmm.
debt by equity, right?
Mm-hmm.
The second is debt divided by equity plus debt. Understood?
Mm-hmm.
Okay, no?
Yeah.
Okay. So if this is too high, that means in your company you have taken too much of loan compared to the equity. So that is bad. Okay. And also when there is loan, it comes with agreements, it comes with terms and conditions, it comes with interest, right? So there is too many risk involved in taking too much loan. Understood? So it should be kept in an ideal level. Understood? No?
Mm-hmm. Mm-hmm.
Okay, Elvira.
Yeah.
Next one, ICR, interest coverage ratio. So what is ICR? ICR basically measures how many times your company can pay interest out of the profit it earns. Understood?
Mm-hmm.
Okay. So the equation is PBIT divided by interest. Understood?
Mm-hmm.
And this particular amount is expressed as times. Clear now?
Mm-hmm. It's
Understood?
profit before interest,
And tax, PBIT, operating
tax.
profit.
Mm-hmm.
Yes. Okay. Understood, no?
Mm-hmm.
So that's it, Elvira. Our lesson is finished. So what you're going to do is revise, see this clip again. Okay, revise all the ratios. And from here, in the question, you have been given 2004, 2005, right?
Mm-hmm.
For all each one. In 2004, you're going to find all these ratios. In 2005, you're going to find all these ratios. Clear?
Mm-hmm.
And everything about the SOPL is given here, right? So profit before tax. In the profit before tax, in order to reach profit before interest and tax, you have to add back interest. Understood? From both sides. Clear, no? Listen to me carefully.
Mm-hmm.
This is PBT, right?
Mm-hmm.
In order to make it PBIT, that is before interest, you have to add back the interest that has been previously deducted. Understood?
Finance cost, it means it's
Yeah,
interest.
finance cost, interest. Finance
Mm-hmm.
cost is interest. So this is the only thing that you need to know extra. Rest of the others are directly given to you. Understood?
Mm-hmm.
Okay.
Mm-hmm.
Current assets are given, non-current assets are given. Okay, you have to find all the ratios for each year. Clear, no?
Mm-hmm.
All of the ratios that we have just discussed. So what you do is you are going to watch the class again. Okay, write
Mm-hmm.
down all the ratios correctly and then apply all those ratios into this SOFP, SOPL and SOFP. Understood?
Mm-hmm.